Welcome back, friends. This is the fourth video on admissible deductions. In the first video we have covered section 29, 30 and 31, and next two videos we have covered section 32, and this is the third video on section 32 and fourth video of admissible deductions. This is actually part 2 of profit and gain for business and profession, and this is mainly meant for income tax course of intermediate students of CS, CMA and CS for the assessment year 25-26 or the previous year 24-25. Let us go back into the balance portion of section 32, depreciations. Now section 32(1)(1), it is dealing with depreciation on power sector undertaking. Now we have already discussed that SLM basis of depreciation can only be opted by power sector undertakings. They can opt SLM or WDV method, but if they opt one of these, they have to continue it for the rest of the years. Now, once they opt for SLM, then they cannot claim additional depreciation. Now, this section is for power sector undertaking and applicable only to power sector undertaking engaged in generation, transmission or distribution of electrical power. Now, they have to exercise this option before the due date of filing return on income under section 139(1). If it is auditable, the last date is 31st of October. For organization record auditing, the last date for filing ROI under section 132(1) is 31st of October, and if no audit required, it is 31st of July in the 11 PY. Now they have to select, opt SLM basis or WDV basis in the PY when they begin generating power, they begin the generation of power. Option to choose SLM or WDV once exercised cannot be reverted, that shall be final. Now the SLM option is only for the tangible assets. For intangible asset, you cannot use this option. Now, when they opt SLM, they can opt it actually for individual basis. I mean, it is not in a block. For each asset, they can select SLM or WDV based upon their benefit. Whichever is beneficial, they can select. For intangible asset, only WDV method is applicable. They cannot choose any SLM method or anything for the intangible asset. For tangible asset, on individual basis, they can decide, they can opt whether that asset is to be depreciated in SLM basis or WDV. Once they opt for that, they cannot revert back. Okay. Individual asset account system for tangible assets is applicable if SLM is opted. Now section 32(1)(3) is discussing about terminal depreciation. So the terminal depreciation can be written off as a loss. Yeah, in the case of power sector undertaking, when they claim depreciation on SLM basis under section 32(1)(1), just we discussed above, if any of the asset is sold or discarded or destroyed in the subsequent PY, then depreciation amount will be the amount by which the money is payable. Okay, this means money is payable in respect to a building machinery, plant, furniture, together with the amount of scrap value, if any, falls short of the WDV thereof. What this means is that depreciation will be available only if the deficiency is actually written off in the books of the assessee. So this depreciation, terminal depreciation, is fully allowed as deduction as a business loss. This terminal depreciation is written off in the books of account. Now, the terminal depreciation is the positive value of the WDV of the asset minus sale value or scrap value. Now, what does that mean? This means that if the asset is sold, the sale value is less than the WDV. Okay, we have the asset, and the asset is being depreciated year by year, and we have got a WDV value. WDV means sale minus the depreciation, will get WDV. Okay, and this WDV value, then at one time we are going to sell it, or we are going to transfer it. When we transfer it, if the sale value we get is lesser than the WDV of the asset, means the actual worth of the asset, what we would have been received, the sale value is less than that amount, that means we have a loss. So that loss or the difference of the WDV and sale value, positive value is different, that means WDV is more than the sale value. That is the terminal depreciation. This terminal depreciation is fully allowed as deduction as a business loss, and terminal depreciation is written off in the books of account. Okay. Then monies payable means actually that will include insurance and salvage or compensation monies payable in respect thereof, and where the building machinery, plant, furniture, etc. is concerned, when it is sold, what price you are getting, that also will include in that. Now, as per section 41(2), this we already discussed in the charging section, charging part. Okay, we have already discussed this. We are discussing it again in section 41(2). What is balancing charge for power sector units? Okay, balancing charge in case of power sector undertaking claiming depreciation under SLM under section 32(1)(1), if any asset is sold, discarded, demolished, destroyed in the subsequent previous year. Okay, so that is actually, then if the sale value is more than the WDV. In the former case, what we discussed is actually sale value is less than the WDV, then we will get a positive value. But if the sale value is more than the WDV and it is lesser than the actual cost, so up to the actual cost, the difference between sale value and WDV is the balancing charge up to the actual cost. Above the actual cost, whatever we get, sale value minus actual cost, that will be short-term capital gain. Now, where the money is payable in respect to the building machinery, plant or furniture referred to in the subsection become due in previous year, in which the business for the purpose of which the building machinery, plant or furniture was being used is no longer in existence, the provision of the subsection shall apply as if the business is in existence in that previous year. Even if the business is not in existence, this can be, this section is applicable. Now let us see the different terms actually, what is our terminal depreciation and balance in charge and short-term capital gain, what we discussed above. Here this picture depicts all these things here. Now let us see that actually when what we discussed above is when sale value is less than the WDV. This is the first case we have discussed. So we have a WDV, means that we have actual cost, from that the depreciations are deducted, then what we get is WDV. When sale value minus WDV is negative, that means sale value is less than, when we discard it or when we transfer it, you are getting a sale value. When what sale value you are getting is less than the actual worth, that means the WDV. That means it is when sale value is lesser, we will get a negative value. Okay, sale value minus WDV is negative. When sale value is less than WDV, then WDV will be more. So WDV minus SV is the sale value is a positive value, which is called terminal depreciation. It's a loss only. It's a loss, and that can be written off in the P&L as business loss. It should be written off in the books of account also. When sale value minus WDV is positive, that means sale value is more than WDV, then there are two cases are there. In the first case, sale value is more than WDV, but actually equal to less than actual cost. The sale value is less than the actual cost and more than WDV. Okay, then what happens? Sale value is more than WDV and actual cost is more than or equal to sale value. So sale value is less than the actual cost and more than WDV. This is what we are discussing. Then what happened? Balancing charge is the difference between sale value and WDV. Means sale value is more than WDV but less than the actual cost. Okay. For example, if your actual cost is 5 lakhs and your WDV after 1 or 2 years, okay, it is coming to maybe 3 lakhs or 4 lakhs. 4 lakhs maybe. Your WDV is 4 lakhs. Okay, but you sold it for 4.5 lakhs. But your actual cost is 5 lakhs. Sold it for, sale value is 4.5 lakhs. Okay, then actually the sale value minus WDV is positive, and that is taxable under PGBP, and it is called a balancing charge. Okay, now we will take an example to make it easy for you. We will take the example here. Okay, now let us consider a case. Let us consider a case where the actual cost is equal to 6 lakhs. Okay, and your WDV after 1 or 2 years, maybe let it be 5 lakhs or maybe 4 lakhs, say. Now you are selling it at a value less than WDV. I mean, you are selling it at your sale cost. First case 1, sale value is 3 lakhs. In this case, what will happen? Sale value is less than the WDV. That means you are at a loss of 1 lakh compared with the WDV. Okay, WDV is the worth of the machinery after depreciation are deducted from the actual cost. So you have got a loss of 1 lakh. This loss, that the difference between WDV, that 4 minus 3 is equal to 1 lakh. This will be your terminal depreciation, and that should be written off in the P&L and should be written off from the books of account also. That will be treated as a business loss. Let's take another case in which actually sale value is 5 lakhs. For example, sale value is 5 lakhs. Okay, that means this 5 lakhs is okay, this 5 lakhs. 5 lakhs is actually less than the actual cost of 6 lakh, and it is greater than the WDV of 4 lakhs. Okay, in such case, what will happen? Now, since it is less than this, so the difference between between the sale value, that is 5 lakhs minus 4 lakhs, is the positive value. Okay, that is 1 lakh. This 1 lakh is your balance in charge under PGBP. This balance in charge is chargeable as income under section 41(2) as PGBP income. Now let us take the third case. Now your actual cost, we know 6 lakhs. Let the sale value, in this case let sale value be 7 lakhs. Okay, double will be 4 lakhs only. Sale value is more than the actual cost. So up to actual cost. Okay, up to actual cost, sale value is more than WDV, 7 lakhs and 4 lakhs. Okay, that's correct. Here actually actual cost 6 is less than the sale value. So up to the actual cost is 6 lakhs minus 4 lakhs, that is 2 lakhs. This will be the balancing charge. Okay, and after the actual cost is reached, means more than the actual cost, whatever amount you are getting, that is 7 lakhs minus actual cost of 6 lakhs is 1 lakh. This will be above the actual cost. Whatever be the sale value is there, that will be short-term capital gain. Okay, that is under 50, under section 50 of capital gain, under section 50. Okay, now we can see it here, same thing is said here. Okay, now okay, as per section 41(2), in case of power sector undertaking which claim depreciation under section 31(1) is sold, discarded, the amount chargeable to income tax as income of business of the previous year is the balancing charge, which is the amount by which the money is payable. This is what we have discussed. Okay, so in other words, balancing charge is the profit on account of such assets of the maximum of the accumulated depreciation. One thing we have to we have to take into consideration is that actually the balancing charge cannot exceed the accumulated depreciation. It is not possible to, and if that is the reason here now, because actually the depreciation, if it is actually more than the depreciation, up to the depreciation can be maximum of the actual cost only. Okay, so that cannot go more than the actual cost also. So that cannot be accumulated depreciation. It cannot go more than the accumulated depreciation. Balancing charge is equal to negative value of the WDV of assets. Sorry, it is the value of it. Yeah, balancing charge is the negative value of the WDV asset minus sale value, or the positive value of sale value minus WDV. Both the same. Okay. Now it is the difference between sale value and WDV. Balancing charge will come into picture when sale value is more than the WDV. Okay. Now in this case actually we have to take a negative value, because actually WDV will be less and sale value will be more. Therefore negative value of the WDV minus sale value is a negative value. Negative value is positive. That way balancing charge is considered. Balancing value cannot exceed the accumulated depreciation claimed on such asset. This is what is important. Balancing charge cannot exceed the accumulated depreciation. Okay, balancing charge cannot exceed the accumulated depreciation. Now as per section 41(2), balancing charge is fully taxable as business income. So balancing charge is a taxable income, is a PGBP income the previous year in which such income falls due. The provision holds good even if the business does not exist in that year. Is what? Even if the in that year, when we charge the balancing, when we calculate the balancing charge, when the asset is sold, the business may not be there. That year actually the business may not be there. Even then, it holds good. Difference between sale price and actual cost shall be treated as capital gain. So when the sale price is more than the actual cost, the difference between sale price and the actual cost is the short-term capital gain as per section 50A. Let us now consider one example. A limited is a power sector undertaking. Now this is actually only for power sector undertaking. The SLM can be used only for power sector undertaking. Now this example also we are discussing about power sector undertaking only. The A limited is a power sector undertaking. Purchased a plant for rupees 50 lakhs on 1/4/22 and it is eligible for depreciation at 15% on SLM. Compute the balancing charge or terminal depreciation assuming the plant is sold on 21/4/2024. After 2 years, the plant is sold. 1/4/22 it is purchased. So then 1/4 mean 22/23, that is first year. Second year 23/24. So it was sold on 21/4. Okay. Mean up to 31/3, 2 year completed, then the next year it is sold. The sold, we will consider 4 cases. First case is actually 7.5 lakhs, second case 30 lakhs, fourth case is 45 lakhs, fifth case is 55 lakhs. Now, in this case, what will be the double DV on 1/4/24? Because actually the depreciation rate is 15%. It is the SLM basis. SLM basis, SLM is what will happen on the actual cost. You have to use the same depreciation. Double DV mean that will not in double DV method or what will happen. We have to first year we will calculate the depreciation that will be deducted. What we get the double DV or the double DV we will for second year we will multiply the double DV at the end of the year, that will be multiplied by the depreciation next year. But in SLM basis that is not the case. Same actual cost will be multiplied by by the depreciation percentage in every year. Okay. Here the actual cost is 50 lakhs. 50 lakhs is the first year. This is actually 1/4/22. Okay. The cost is 50 lakhs. Then it is then for that year actually 22/23 depreciation is 15%. You can see here computation how double will be calculated. Original cost 50 lakhs less depreciation 22/23 15% is 7.5 lakhs. Okay, where actually that scrap value is assumed nil. Okay, now double DV as on 1/4/20. Again next year double DV. Again depreciation will be to be deducted. Then we will get 35 lakhs. In all the 3 cases, double DV as on 1/4/24 is 35 lakhs only. Now the sales proceeds we have to deduct. Sales proceeds first case it is 7.5 lakhs. So it is sold for 7.5 lakhs when in actually 21/4/24 it is sold. Now here what happened? The sale value is less than the double DV. In such case, what we will get the terminal depreciation. When sale value is less than the double DV, we will get this terminal depreciation. So the difference between sale value and double DV is 27.5 lakhs is that will be the terminal depreciation. So there is no balancing charge or there is no short-term capital gain. Nothing is there because only terminal depreciation is a business loss. Okay. Now in second case, it was sold for 30 lakhs. Now what happens? The sale value is less. In this case also, the difference is 5 lakhs. So this 5 lakhs is terminal depreciation. Okay. Now in the third case, the sale value is 45 lakhs, which is 10 lakhs more than the double DV. But the 45 lakhs is less than the original cost of 50 lakhs. Okay, actual cost less than actual cost, but actually more than the double DV. In such case, what we will get? We will get the balancing charge. Okay, so the difference is balancing charge since it is less than the actual cost. Now next case 55 lakhs it is sold, means it is more than the actual cost of 50 lakhs. So up to 50 lakhs we will get balancing charge. After 50 lakhs we will get the short-term capital gain. So 35 minus 50 lakhs. 50 lakhs will be the balancing charge and the 55 minus 50, 5 lakhs will be the short-term capital gain. Okay. Now the balancing charge cannot exceed accumulated depreciation claimed on such assets. This is what we have discussed above also. Okay. The total negative balancing charge in case of D is 20 lakhs. Okay. In case of D, so what will happen in case of D, case D? Case D, it is actually 20 lakhs. 20 lakhs. So because it is a negative balancing charge, it is a 20 lakhs only. But we cannot claim 20 lakhs for balancing charge because the depreciation is only 15 lakhs. 50 is the original cost and WDV is 35 and 50 minus 35 is the depreciation. Maximum 50 lakhs only we can charge for balancing charge. So balancing charge cannot exceed the accumulated depreciation. So the rest we have to charge in short-term capital gain. This is what we have done here. Okay, same thing is being told here. Actually, the difference is 20 lakhs balancing charge, which is more than 50 lakhs, 15 lakhs. Therefore, the accumulated depreciation of 15 lakhs we have to consider for balancing charge. Then balancing charge is restricted to 15 and the balance 5 shall be treated as short-term capital gain. Let us consider one more example. So, B Electric Supply Company Limited, which is charging depreciation on SLM, whose actual cost of asset was 20 lakhs and WDV is 18 lakhs 72,300, sold the said asset during 24-25 after 2 years. So 2 years it collected or it claimed the depreciation 2 years on SLM basis. Then after that actually it was sold. What will be the tax treatment for assessment year 25-26? That means previous year 24-25 if the asset is sold for. There are 4 cases. First case is 30,000, then 80 lakhs 72,300, the same price. What WDV, the equal WDV, then less than WDV, then 19.8 lakhs more than WDV. This is 21 lakhs is actually more than the actual cost. So 4 cases we are considering here. So we know that actually WDV is already given 18 lakhs 72,300. It's the same for all 4 cases. Less sales proceeds. First case it is told 30,000. Second case 18 lakhs 72,300. Same price, more than the WDV, more than the actual cost. So in the first case, what will happen? The sale price is less than the WDV. Therefore, what we will get is the terminal depreciation. Okay. Now in the second case, both are same. WDV and sale cost is same. Therefore, there is no terminal depreciation, no balancing charge, no short-term capital gain. Nothing is there. Okay. Balance is 0. And in the third case, actually sale value is more than the WDV. That means you have a case of balancing charge. Okay. So your 10,000, sorry, 1 lakh 7,700. Okay, that will be your balancing charge. Now, in the fourth case, you have a case of balancing charge and short-term capital gain. Because short-term capital gain, why? Because it is more than the actual cost of 20 lakhs. 20 lakhs is the actual cost. So, up to 20 lakhs, it will be 2,27,700. It will be the balancing charge. Okay, up to, because see the difference in this image. Therefore, sorry, up to 20 lakhs mean 1,27,700. That will be the balancing charge, and the rest of the amount 1 lakh, 21 lakhs minus 20, that is the short-term capital gain. Okay. Now let us try to understand what is meant by actual cost. What is the definition of actual cost, and how actual cost is calculated. Section 43(1) explains the actual cost. Now, actual cost is actually the cost for which the asset is acquired minus the cost of acquisition or construction. Okay, or you can say that, or if you are getting some government grant or something, that is to be deducted from that. So it is the net cost. Actual cost means the actual cost of the asset to the assessee reduced by the portion of the cost thereof, if any, as has been made directly or indirectly, or indirect cost and indirect cost will be deducted from the cost. The following costs shall be included in the cost of fixed asset to calculate the actual cost. What are the costs that we can add to the to the actual cost to come to the actual cost? That is also another thing. Now what we told first was actually the actual cost, how it will be calculated, what are the things to be deducted. Now what are the things that can be added to come to the cost of the asset, cost plus that or actual cost of the asset. There are two parts are there, and in what can be added. First is the cost price of the asset. Now interest or on money borrowed for the purchase of the asset till the asset is put to use. Okay, we are buying some asset, and from the date of purchase, okay, to the date to put to use, we got, we have maybe we have to pay some interest on that, on the borrowed money. If we have taken money from the bank, on the borrowed money, some interest is to be paid. After the date of put to use, whatever money is coming, that will be added to the capital asset. That cost will be added to the capital asset. Okay, bank charges, then charges on bank guarantee, LC, everything will come into that. Letter of credit and all. What is letter of credit? Now, okay, let us see what is letter of credit. Letter of credit is actually a contractual commitment by a foreign buyer's bank to pay when the exporter ships the goods and presents the required documentation to the exporter's bank as a proof. Okay. Now, you are buying some asset from a foreign country. So you don't know, if you pay the money in advance, you don't know whether that person will send the asset to you. And if that person sends the asset to us, ship the asset to us, he is not sure whether he will pay the money or not. There's a mistrust. So for that actually the letter of credit is coming into picture. So it is a contractual commitment by the foreign buyer's bank to pay when the exporter ships the goods. Now if we are buying, our bank will give will give a commitment, contractual commitment, that once the shipment is done, okay, and if the documents are presented to the bank as a proof of that, then the money will be transferred to him. As a trade finance tool, letter of credit is designed to protect both exporters and importers, and both exporters and importers are getting the benefit of this. They can help you win business with the new clients in foreign markets, because we don't know what we have in the other end. So there is a there will be some kind of mistrust between both. So to mitigate this kind of thing, the letter of credit is coming into picture. This means that the exporter gets a guarantee of payment while offering the importer reasonable payment terms. Now there is something called bank guarantee. So what is bank guarantee? A bank guarantee is a promise from a bank that it will pay the third party if the debtor defaults the loan or contract. It is a way to build trust between businesses, especially for large transactions. The bank acts as a guarantor for the debtor. If the debtor doesn't pay, the bank will pay the third party. Okay. For that, the bank may ask for some collateral or deposit something from you. That is also there. Okay. So bank guarantee, the bank promises that in case for example, I will take a very small example. Now there is a contract is there. In the contract, one term is there. If then the asset is not supplied in time, so there will be some charges will be there, some compensation will be paid. So this actually we are keeping our money in our bank, and the bank will give a guarantee to them. Actually, okay, it is not paid in time. Actually, this money will be transferred to them. Transferred to them. That compensation will be paid. Like that, some guarantee bank is giving. So if they give the proof that it is, the party has defaulted, okay, then actually the bank will give the compensation money to the other party. Like that, there is a bank guarantee. The bank is given the guarantee, assurance. This is what is called bank guarantee. Now, direct expenses including traveling expenses for acquiring this asset. This can be added to the cost of the asset. Okay. Now, the cost for bank guarantee, LC, okay, the interest on money borrowed for purchase of asset till the asset is put to use. Then cost of the asset, of course, it is there. Then direct expenses including traveling expenses for acquiring the asset. Okay, if you are acquiring the asset from China, you have to travel to China. You have to check it. You have to go to the factory. You have to test the equipment there. You have to find out whether it is actually usable for your production. All the things you have to do. So there is an expense for that. This expense can be added to the cost of the asset. Then once the asset is brought, then you have to install it. There are some installation charges. That means you have to make a foundation or whatever. Then actually some charges are included, incurred for you. That charge also can be added here. The cost of repairs and modification prior to use of the asset to make it ready to use. Okay, once it reach here, it is not compatible, or maybe you have to make some adjustment, some modification you have to make. Then only it will be suitable for Indian conditions and all. That cost also prior to use of the asset, if you have done some modifications, repair, that cost also can be added to the cost of the asset. Some training expenses of the staff before the use of the plant. The staff is to be trained, so the training expense also will be added to the cost. Then expenses on essential construction work such as foundation to fix the machinery, cold storage rooms, cooling towers. Okay, if you want some cooling towers or something, okay, maybe some cold storage rooms and all, everything can be added with this. Expenses necessary to bring the asset to site, installation, and to make it ready for use, carriage inward, loading and unloading, trial run cost, installation charges, everything can be added till it is put to use. Whatever cost is incurred till put to use can be added to the cost of the asset. If you get any revenue by selling the trial run products, okay, now you have tested your machinery and some trial run is done, some products are produced, some items are produced. Now this, if you are getting some amount out of this by selling this, that should be deducted from the cost of asset. If you get any revenue by selling the trial run product, it should be deducted from the cost of asset. It should not be transferred to P&L as income. It is not an income, because income will come when you have commercially started the production. You are not commercially started the production. You have just tested it and some trial run conducted and some items were produced and the quality were good. Actually, you can sell it and that amount will be deducted from the cost of asset. Whatever cost is there, you can deduct it from that. Okay. It is earned before the commercial production or put to use. Expense on insurance, power and fuel incurred before the commencement of business. Okay, now you go, some insurance expenses you actually incurred. Okay, or some insurance you have taken on the machinery. All these things before commencement business can be incurred. Some maybe some fuel is required, some diesel required for running the machinery. That cost also you can add here, or maybe power supply cost, that also whatever cost before the commercial production or put to use can be added to the cost of the machinery as a capital expense. Expenses that are incurred for increase in the capacity to or make it fit prior to use. Okay, if you want to increase the capacity, some capacity is being increased. Okay, now you brought the machinery, but actually the space is not enough. So what you will do, you have to increase the space, so that expense actually to increase in the capacity, then only it will fit there. Or actually once the things are produced, actually then you need more storage spaces. For those storage spaces they required, whatever production is done, you have to store it. For that, actually for increase the capacity, you need storage space also. That is a part of it. Therefore that expense can be also added to that. Now we can say, what are the events that can be added to capital cost? Loan taken to purchase the asset. Okay, then the purchased asset, then installation cost, then trial run cost till ready to use, the put to use. So up to put to use, whatever cost is there. If we take the interest, for example, interest cap and the interest till the date of put to use can be capitalized till the point that is added to the cost of asset. After is put to use, the interest is revenue expense. Then loan repayment and interest and EMA, everything will be revenue expense after that. Now computation of the actual cost, if you are saying actually the cost of acquisition, okay, and you have to add the interest on loan till put to use or over date of commencement production. All these are capital expenses. Then you get interest is capital expense till put to use. After that it will be revenue expenses, be charged to P&L. Then expenses incurred for acquiring asset, we are told actually freight, insurance, loading, unloading, everything will be added to the capital expenditure. Now expenses incurred in connection with installation charges, trial and charges, then forex fluctuations for assets acquired from abroad. Okay, you some forex fluctuation when actually that repayment started actually that time before the machinery is put to use, whatever forex fluctuations, because you purchased, okay, the asset when the dollar price in rupees was 84 rupees, and when you are trying to repay, the amount is coming to 90 rupees, okay, per dollar. So there is the fluctuations there, and that difference in fluctuation of the dollar, because of that actually forex fluctuations, okay, that will be added to the capital cost. Now less any amount received from trial and product selling on all. If you say sell the trial and products, you will get some amount. Then subsidy or grant received by from government, by authority, directly, indirectly. Then actual cost for computing that is the actual cost for the computing the depreciation. Then that will be the actual cost. You deduct these two costs, then you will get the actual cost. Let us discuss some points regarding the actual cost. The maximum amount that you can spend in cash for acquiring any asset is 10,000 rupees per day per asset. More than that, if you are spending, you cannot be included actually for the calculation of actual cost. Okay, you have to do the payment through bank only, through account by check or through net banking or any other electronic transfer you have to do. If you have paid the amount through by cash for more than 10,000 rupees per day per asset, then you will not consider it as in the actual cost. Any expenditure on acquisition of any asset shall be ignored if such expenditure is made in cash exceeding 10,000 per day per bill. For example, if a machine purchased by paying 20,000 cash, 30,000 by bank, then only this 30,000 will be considered, because the 20,000 cash paid is actually more than 10,000. So that will not be considered. Only 30,000 will be considered as the cost of the account, and you can claim depreciation only though in that amount. Now we will consider two examples. One machine purchased for 20,000, cash paid 10,000 in one day, morning 10 a.m. and evening again you made actually 10,000. That means in a day more than 10,000 paid here, 20,000 paid. Therefore it is not allowed. Okay. Second example. Okay. Second example is machine purchased for 1 lakh and every day 10,000 paid in cash for 10 days. So that is allowable. Why? Because one day that shall not exceed 10,000. And third case, machine purchase for 30,000 and actually one day you paid 5,000, second day you paid 10,000 in cash and balance in account pay check. That is allowable. Why? Because in cash you have paid only 10,000. More than 10,000 per day you paid in cash. Account pay check is actually always allowed. Therefore there is no issue in that. Third case, two machines you purchased X and Y, one for 8,000, second for 7,000. you paid cash of 15,000. This is also allowed. Why? Because actually per bill you can pay per day only 10,000. This is actually two separate machines, actually separate payment. Therefore, paid in cash 15,000 for two machineries. Therefore, it is allowable. Now, scientific assets. For example, you will consider that scientific asset or actually specified business asset. Scientific asset under section 35 and specified business 35D. We will learn all the things actually in the coming sections and all. You will learn. Okay. Now, for the time being, I am just mentioning this. Please bear with me. Okay. And these two cases, we are getting 100% deduction for depreciation. So, some asset was brought to business and we claim the depreciation under 35 or 35D. Okay, 100% deduction we obtained. Such case, actual cost is actual cost to the assessee minus deductions taken. It will be nil. Therefore, actual cost, your actual cost is nil in this case. Why? Because you have taken 100% deductions. So there is no cost for you. Actual cost should be considered as nil. Already 100% deduction allowed to you. Now, another case such as the conversion of stock in trade. Some stock in trade, if you are converted, okay, if you have some AC and you are a AC dealer, you have one AC you use for your office. That means your inventory is converted into capital asset. In such case, actually, you have to consider the fair market value of the inventory that's converted into your asset as your capital asset. Will be your actual cost. Okay. Then you are converting your stock in trade to capital asset. So the cost of the fair market value of the stock in trade you have to consider for your actual cost. Now, you acquired some assets by gift or will or inheritance, something like that. You acquired. So the actual cost when you are when you are calculating, it should be the WDV in hands of the previous owner. The previous owner actually, okay, he purchased this. He has actually availed some deductions on that, maybe depreciation they deducted, then he has a WDV from the date of purchase. So that WDV in the hands of the previous owner, okay, that means actual cost minus accumulated depreciation is the WDV, that's for the previous owner. Okay, the same WDV will be the actual cost in the hands of the, same WDV, that will be the actual cost for you when it is inherited to you. Okay, now next case we can consider, okay, some second-hand machine you are purchasing, maybe at a higher cost or whatever. So you have not availed any depreciation for that, or your previous owner also not availed in depreciation on that second-hand machine you are purchasing, and that machine, and for you can for an amount you purchase maybe at a higher rate than the fair market value, whatever. For that amount you can avail the depreciation on that. Okay, so that you will show it as your actual cost. But actually, if the assessing officer of income tax is convinced that you have done so, okay, you have purchased a second-hand machinery to reduce the income tax liability, because you have to show higher depreciation and you can reduce your income tax liability. For that purpose, that being your purpose, you have purchased the second-hand machinery and brought into your business. By claiming depreciation for enhanced cost, you can you can reduce your tax liability. If the assessing officer, okay, now convinced that, then actually the assessing officer with the previous approval of the Joint Commissioner of Income Tax can determine the actual cost with regard to the facts and circumstances of the case. So he can assess the actual cost. In such cases, the assessing officer will assess the actual cost for you. Now, reacquisition of transferred asset used earlier for one's business or profession. Now, you have sold your asset. Now you are reacquiring it. You are buying back again. Such case, actual cost will be the WDV at the time of first transfer, or the price paid for reacquisition, whichever is lower. So, you transferred it or you sold it. What will be the WDV at that time for you? Or the price you paid for reacquisition when you paid, when you brought it back, or when you bought it back, what is the price you paid? And whichever is lower, the WDV or the price you paid, whichever is lower, that will be the actual cost. Now, sale and leaseback transactions. This case actually, assets acquired by an assessee from another person. Okay. Now, Mr. Y is buying an asset from Mr. X. Asset acquired by an assessee or transferred from another person. Okay, seller or transferor, whoever. Okay, he is buying it. Who used it for his business or profession? And one person was using one asset for his business or profession. From him, another person is buying it. X is having an asset, he is using it for his business, and it is being transferred to Y. Y is buying it. Okay, and what he will do, he will lease it back to X again as a lessor. Okay, in such case, then he let out on hire or lease to the same person who had earlier claimed depreciation on such as asset, and X was using the product for his business and he was claiming depreciation on that, and he has sold it to Y. Then he has taken back on lease from Y. Okay, in such case, WDV in the hands of the transferee is equal to WDV in the hands of the transferor, from whom he has acquired and whom it was leased back, is equal to actual cost to the transferee. So, what will be the actual cost for the transferee or the lessor who bought the asset from X? Here, the case of Mr. Y, he bought it from X. Then actually, what was WDV when he was transferring to Y will be the actual cost for Mr. Y or the transferee. Now, building used for non-business purpose earlier was brought into business subsequently. Okay, I had a building. The building was used for my personal purpose and all. This building, on one particular date, I am transferring to my business. I am using it for business. So the actual cost of the building when brought into business. Then when I brought the building to my business, what is my actual cost? The actual cost will be the depreciation calculated the right in force on the date that would have been allowed had the building been used for the business purpose since the date of acquisition by the assessee. I have acquired a building and the building was used for my personal purpose. I used it for 2 years. Then the third year I brought the building to my business. Then you have to calculate the WDV as if the building was in business from the date of acquisition, when the day I purchased it, bought it. From that date onwards, 2 years if I use for personal purpose, that also you have to consider for the 2 years also. You have to calculate the depreciation and WDV. And the third year, when it brought to business, what will be the WDV? That WDV will be your actual cost. One example will show you Mr. A acquired a building on 21/22 previous year and used for personal purpose. In 24-25, okay, brought the same to his business. That means two. Actually, 21-22 he brought, then 21-22, 20-23, then 23-24, 3 years. Okay. Then the actual cost of the building when brought to business is equal to WDV of the building as if it was used for business from the date of acquisition, which is equal to actual cost of the building when purchased in 21-22 less depreciations for 3 years, that 21-22, 22-23 and 23-24 at current rate, at the depreciation rate when it was brought into business. For that previous year, what was the current rate for, current depreciation for the building? That depreciation rate is applicable for when that rate you will consider for all the previous 3 years. You have to consider the depreciation, and that is to be deducted from the actual cost to come to the WDV, and that WDV will be your actual cost. Notional depreciation, the rate applicable at the date of conversion. Okay, and this is applicable only for buildings and not for plant and machinery. Now a number of explanations are there in this section. Now we reached only up to explanation 5. Okay, now the balance explanation and all, and the balance portion of the section 32 will be explained in the next video. Okay, till then, goodbye.